Good evening, everyone, and welcome back to our daily U.S. stock market index watch. Today is March 6th. As we mentioned yesterday, we had already issued a strong warning to everyone. The overall market environment had become extremely tense and fragile. And sure enough, today all three major U.S. stock indices moved lower together. From a technical analysis perspective, this outcome had already been clearly signaled over the past couple of days. That's why we reminded everyone to stay cautious. At a time like this, the strategy should shift toward defense. Any aggressive allocations or main theme positions should be reviewed and adjusted appropriately. Yesterday, we also categorized and recommended several defensive stocks for everyone. Looking at today's performance, these defensive names actually held up very well. For example, we've repeatedly mentioned on this channel that Cal-Maine Foods has been showing strong relative performance. Today, it even moved higher against the broader market trend. From a chart perspective, it is also setting up to break out of a head and shoulders bottom pattern. There may still be a short-term retest around this area, but the probability of a breakout above this inverse head and shoulders structure is already above 60%. The odds are clearly tilted toward an upside break. This also shows the value of what we've been doing on this channel. If you look back at our earlier videos, many days ago, we were already telling everyone that the market warning level had been raised from level 4 to level 5, and then again back to level 5. We deliberately quantify these warnings so everyone can easily understand what kind of market environment we're currently in. Now let's look at the Dow Jones Industrial average. The chart is looking quite weak. It has already come down to test the 150-day moving average. In fact, throughout this entire bull run, the index had never really touched the 150-day line. Since breaking above the 150-day moving average back in June last year, the market had no intention of revisiting it. Most of the time, the index simply moved higher along the 50-day moving average. On my chart, it shows the 55-day line, but you can think of it as roughly the 60-day moving average that most trading systems use by default. The market had basically been trending upward along that 60-day support line. Under these circumstances, we would say the market is now showing a shift in risk appetite. But does a shift in risk appetite mean that the entire bull market is about to end? Next, I'll walk everyone through this in detail and explain whether this rally is truly coming to an end. All right, let's take a look. Previously, we mentioned that the market had been consolidating at high levels, right? Then we saw a test of the 50,000 level on the upside. After that level was tested, the index immediately pulled back. On that very day, our channel already reminded everyone, if the test of 50,000 quickly returns back into the channel, then in the short term, it would be very difficult for the market to break above 50,000 again. At best, the index would simply continue moving within the channel, which would actually be a very healthy structure. However, once that channel gets broken, even if it's just a brief downward spike below it, you still need to recognize it as a very dangerous signal. And we pointed this out on that very day. Even though the price moved back into the channel afterward, we did not change our stance. We didn't say one thing today and something different tomorrow. Our message remained consistent. Continue to warn about market risk. At most, the warning level was lowered from level 5 to level 3, but it never dropped below that. Now today, this long lower shadow has clearly triggered panic in the market. The main reason for that panic is today's U.S. Nonfarm payrolls report. The data came in far worse than expected. The forecast was for 50,000 new jobs, but instead employment unexpectedly dropped by 90,000. This isn't just a surprise index anymore. It's more like a shock index. The deviation was extremely large. As a result, the broader market has started to price in stagflation fears. Over the past couple of days, we've repeatedly mentioned the term stagflation. The reason we emphasize this word so often is because it represents one of the most difficult situations for governments to deal with. Since the collapse of the Bretton Woods system, the global economic framework has largely become a government intervention-driven system. Within such a system, the most difficult macroeconomic challenge, ranked number 1, is stagflation. Stagflation means economic stagnation combined with persistently high inflation. It's an extremely dangerous combination. And in the short term, the conflict involving Iran clearly isn't going to end quickly. I've said this before. Don't listen when governments say the war will be over in 3 weeks or 4 weeks. Don't rely on those statements. Instead, watch the financial markets. In the markets, people vote with their money. That is the most accurate signal. Press conferences, reports, congressional speeches, presidential statements, those are far less meaningful. Because in the market, there will always be participants who have access to inside information. So right now, the shadow of stagflation is fully hanging over the United States. And for countries that rely heavily on imported inflation, such as Japan and South Korea, the same stagflation pressure is also beginning to appear. Especially under the combined forces of the AI revolution and persistently high inflation, the group that ultimately suffers the most is still ordinary people. Under these circumstances, everyone must recognize that this signal is already a true panic signal. This isn't just the panic shown in some volatility index. This is real panic among traders and investors themselves. However, I want to point out that a short-term rebound or pullback rally is still possible at this point. Why might that happen? The main reason is portfolio rebalancing by hedge funds. For viewers who follow this channel regularly, you already know that we have recommended several defensive stocks, such as Cal-Maine Foods. These are what we classify as defensive positions. At the same time, we've suggested reducing exposure to things like software sector ETFs. For example, iShares expanded tech software sector ETF. Yesterday, I explained that these defensive names fall into our third category of defensive strategy. In the past, many investors might not have paid attention to these stocks. They had been underperforming and trending downward for a long time, especially during the height of the AI bubble, when everyone only focused on high-growth technology names. But as I mentioned yesterday, these are now part of the defensive allocation framework. And what happened today? These stocks continued to move higher. This type of price action often reflects hedge funds rotating their portfolios. As they rebalance their positions, capital begins to shift into defensive sectors. That rotation can sometimes push certain individual stocks sharply higher, which in turn creates a broader market rebound. However, it's important to understand the nature of that rebound. At this stage, the market mindset has already shifted toward defense. Investors are not adding new capital from outside the market. Instead, they are simply reallocating the money that is already invested in equities. In other words, investors are adjusting their existing positions, but they are no longer taking fresh cash from their pockets to enter the market. When that happens, something called buying exhaustion begins to appear. Investors stop initiating new purchases, and the overall buying volume in the market drops significantly. Once buying demand weakens, the market can easily resume its downward trend. So where could a rebound reach? One possibility is that the market simply rebounds back to this resistance line and then rolls over again. Another possibility is that it bounces back toward the upper boundary of the range before turning lower again. But overall, looking at the current structure, while nothing in markets is ever 100% certain, the probability of the market moving lower from here is around 70%. As for which scenario the market will follow on the way down, even I don't know. In financial markets, no one can predict the future with certainty. However, once the market enters a panic phase, we can still reason through the likely behavior of participants, both Wall Street institutions and retail investors. Generally, people will take three types of actions. First, they stop buying. Investors begin to observe the market. At the very least, even if you don't sell or short the market, you will pause and watch. At this stage, very few people will continue blindly buying into the market. Second, investors begin portfolio rebalancing. This repositioning process can sometimes trigger temporary rebounds. Third, if a large wave of short sellers enters the market, then the situation changes significantly. Once the short selling momentum builds, that would likely signal that this current rally cycle has come to an end. Looking at the broader trend, we've been in a small bull run since last year. If we define the larger bull market, then it actually started back in 2023, which would make this a 3-year bull cycle. If the bearish scenario fully plays out, then we could say this bull market phase would be coming to an end. That said, how deep the decline could go is another question. The support levels below are still relatively strong. Because of that, the magnitude of this correction may not be extremely deep. Markets that fall very quickly often also experience fast rebounds. Now, here's the key point. If you're currently trapped in a losing position, don't panic. When markets drop rapidly, you should avoid panic selling. Of course, if the price has already hit your stop loss level, then the rule is simple: execute the stop loss. But if you suddenly wake up and discover that your stock position is already down 30% after a rapid sell-off, the first step is still not to panic. Wait for a rebound. Then set a psychological stop loss level, for example, 15% or 20%. When the rebound reaches that level, exit without hesitation. If the market continues to rebound afterward, that move has nothing to do with you anymore. Don't dwell on it and don't regret the decision. Why? Because you have already executed the correct trading discipline. Where the market goes afterward is something we cannot control. The only thing we can control is our own actions and risk management. Now let's go back to the Nasdaq composite. Compared with the other indices, the Nasdaq actually held up relatively well today. That's right, it showed stronger resilience. Overall, the three major U.S. indices all experienced significant declines today, but if you look at the technical structure, the Nasdaq's decline was not that large in terms of position on the chart. Yesterday, I already mentioned that the Nasdaq was very likely to fall today. The real question was how it would consolidate within the weak zone. Today, the market gave what I think is actually a fairly strong answer. In fact, many individual stocks were sold off excessively. In my view, some of them were wrongly punished by the market, and the decline went a bit too far. Let's take a look at NVIDIA. NVIDIA basically continued the downward movement within the range that we discussed yesterday. However, it still appears relatively resilient because the key support levels have not been broken. That's why I mentioned earlier that there could be a rebound next. A rebound is very possible. But if a rebound happens, which index will bounce more strongly? In my personal view, it might not be the software or tech stocks. Instead, the stronger rebound could actually appear in the Dow Jones Industrial Average. Why? Because during times of war or geopolitical conflict, the biggest impact is usually on raw material prices. In other words, the cost side of the economy. So where do those cost pressures show up the most? In sectors like chemicals and materials. And today, the materials sector was actually one of the hardest hit. On the other hand, energy stocks performed the best today. Why? Because crude oil prices have already surged to around $90 per barrel, and now it's closer to $92 per barrel. So whether we're talking about the biggest losers or the biggest gainers, many of them are components within the Dow Jones sector mix. That's why it's very possible that a short-term oversold rebound could occur in the Dow Jones Industrial average. Therefore, if you currently hold Dow Jones component stocks, you should not rush to sell them easily. Next, let's talk about the index that I personally consider the most valuable and the most meaningful reference, the S&P 500. Why? Because I've always said that the S&P 500 represents rationality. It reflects the collective voting of the smartest investors in the market. So how the S&P 500 moves often signals the direction the market may take next. Looking at the 4-hour chart, the S&P 500 has formed a very ugly candlestick structure. Let me describe it. This kind of pattern, this two candlestick combination, is one of the worst looking formations in technical analysis. What it represents is a failed rebound. Here's what happened. There was a long lower shadow suggesting a rebound, but within the next 4 hours, more than half of that lower shadow was completely reclaimed by selling pressure. More than half of the rebound move was erased. What does that mean? It means the bearish side completely won the battle, and they won it very decisively. That's why this pattern is extremely bearish looking. Under this kind of structure, the implication for the next move is very clear. The market will likely break below support levels. So overall, although I personally believe that the Dow Jones might experience a short-term rebound next, regardless of the size of that rebound, the overall market structure has already been damaged. Don't just look at the fact that the S&P 500 hasn't technically broken its support level yet. In my view, the structure is already broken. From here, the market will almost certainly come down to test the lower support level again. And the key question after that is simple. Will that lower support hold? If that support fails to hold, then the situation will become very dangerous. Overall, the market has clearly entered a highly tense and fragile stage. In simple terms, the problem is that this conflict with Iran was badly timed. Why badly timed? Because it happened right when the domestic economic cycle may be approaching an inflection point, and when the main investment themes within the market may already be showing signs of a bubble. Launching a conflict under these conditions pushes up raw material and cost pressures, which leads to cost push inflation. That immediately puts the Federal Reserve in an extremely difficult position. If they cut interest rates, it could further accelerate inflation. If they do not cut rates, the labor market data already looks weak. On top of that, the current Fed leadership is approaching a transition. Jerome Powell is expected to step down from his term around May. Now imagine this situation. If someone has worked in a position for 10 years and performed quite well, and right before leaving they are handed a huge mess to deal with, what would most people do? Usually they would try to delay major decisions as much as possible. Of course, I don't know whether Powell personally thinks this way. It's also possible that before leaving office, he might take very aggressive or decisive policy actions. But judging from the current situation, that possibility does not seem very high. So the interest rate decision becomes extremely difficult, while at the same time the investment environment is not very optimistic. When I talk about the economic outlook here, I'm not referring to the entire macro economy, but rather to the main investment themes driving the market. Under these circumstances, the market could start forming a top. If you want to understand the overall trend of U.S. equities, honestly, just watching the S&P 500 is enough. I mentioned before that the chart here could develop into a rounded top pattern. And as we can see now, that possibility is indeed appearing. Of course, when I say this, some people may feel it sounds exaggerated, as if the market is about to end immediately. That's not necessarily the case. The structure could still evolve in different ways. It might move like this or like this. There are several possible paths, but the overall structure still resembles a rounded top. If the trend develops more gradually, the market could still produce a rebound and then continue forming that larger rounded pattern. However, based on the current situation, I personally think the cycle might end earlier than expected. That said, there's no need to panic. If you currently hold a diversified investment portfolio, this is the time to start adjusting your positions. The next trading session may bring some reactions because during the weekend news and narratives often develop further, and after a couple of days, the market sometimes calms down and reassesses the situation. So early next week, there could be a rebound. If that rebound happens, the strategy should be clear. First, reduce exposure to growth stocks, especially the AI-related and semiconductor names that have been leading the market. Second, rotate into more defensive sectors, similar to the defensive names we recommended in previous sessions. There's also another stock we intended to discuss today, but we ran out of time. We'll cover it tomorrow. The ticker is BWX Technologies. You can add it to your watch list for now. Time is limited today, so we won't go into more detail. In summary, if you are currently stuck in losing positions, the next trading session may provide an opportunity. If a rebound appears, use it to rebalance or reduce positions. Of course, nothing is guaranteed. It's also possible that something unexpected happens over the weekend, some kind of black swan event, and the market might drop further instead of rebounding. That's always possible because we still have 2 days before the next session. But if no major news emerges over the weekend, the probability of a small rebound is relatively high. If that rebound comes, act quickly. Reduce positions where necessary and rebalance your portfolio. That's all for today's discussion. We'll see you in the next trading session.